I'll hand you straight over to Tom Williams. So welcome everybody. You ready, Tom?
Yeah.
Just show the screen. Oh, over to Tom Williams.
How fast?
It is.
Yeah, hi everybody. Tom Williams here, speaking to you from Worthing, a nice little holiday town in the south coast of England. It's about 40 miles south of London. We've got Gavin's back from Australia. He came back Tuesday, and all day Tuesday he said he was as if he was in some sort of dream. Still am, he said. It's 22 hours, which is not very pleasant. But anyway, nice to thank you very much for showing up here. And please ask any questions, and Rita will read them out, and we'll do our best to answer them. Now, they can see my chart, can they, Pete?
Yep.
Okay, now this is a daily chart of the S&P 500 future, and it will run in harmony with the main index. That's ensured by these, what they call arbitrage traders, that ensure that they will, all the markets will run closely together. Otherwise, they have some sort of formula where they can buy one, sell one instantly and make a profit, small profit from the price difference of one to the other. And of course, this is a purely professional activity. We can't do it because there's too many contracts involved. But that's why all these indexes will run closely together. So we can be rest assured, if you're looking at this chart, the main S&P and all the rest will be doing exactly the same thing. Now, as you know, I like to look at the daily chart first when I'm analyzing a market. We know why it's fallen down to here. Notice it seems to be rushing towards this lower trend line. So don't be surprised if it doesn't hit this lower trend line somewhere along here. Now, why has it fallen? Well, it's fallen because we've got clear weakness here in the background. There's the very high volume, look. And there's supply there, look. Overcoming demand on the up bar there. When weakness appears, it will always appear on the up bar. And you can see up here, it's overbought anyway. Professional money that's been involved in the bullish move will sometime want to start taking profits. And you can see that because it'll be an up bar pushed up like that. The volume will be high, very high, right? And of course it's overbought above that trend line. Okay, so then it moves sideways, look. And lo and behold, there's an upthrust.
Upthrust.
That says upthrust, does it?
It does.
Read these dialog boxes, please. I heard somebody say people don't read them. There's a lot of information there, all in there. We don't hold any secrets back. We tell you everything we know. And there are no secrets in the stock market because there's too many clever people out there to try to make out that you've got secrets and nobody else knows. A load of rubbish. If you hear anybody telling you that they've got secrets, then you're being groomed for a con. That's almost certain. So be wary. It's a very, very dangerous place, the stock market. Very dangerous indeed. I mean, the market seems to automatically behave in such a way that it's going to mislead you. But it won't mislead you if you follow the principles. And this is one principle here There's definitely very, very clear, look, up thrust. Okay. That means that the professional money are fully aware that there was distribution all through this top here. And so they, given the opportunities, they ram the market up, catch stops. Don't forget that above and below these actively traded markets are not hundreds but thousands of stops. And if they can trigger them off, they know where the stops are, most of them, because of the way the herd behaves. They know roughly where they are, and they will trigger all those stops off, and it's very profitable then to do that at these high levels, right? Then you have a widespread down look, which is indicative of weakness, even though we saw we had a bit of a rally here. Now, there was some sort of support came in here. We got some green arrows, but then it went up here, look, and there's an up thrust, another one. Now, there's no signal on that particular time frame, but you should be able to recognize that. I think we were doing a seminar, was it last week, and we pointed that out, that the market was highly unlikely to go up higher than this resistance. These old tops are resistance to higher prices. So keep that in mind. And it certainly won't go up there on no demand, which I think the volume on these up bars is quite low. I think we pointed that out. The market turns around and falls. Look, these wide spreads, look, close on the low as it rushes towards former areas of support is basically bearish. It's not indicative of higher prices at all. It's now falling here. There's a little bit of support, I think, came in here, right? But don't be surprised if this market doesn't hit this trend line sometime.
Say something, Tom.
Yeah.
Into the microphone. Yeah, so we're looking at the daily futures chart from eSignal, and a question that comes up from time to time, I'm sure many people have got this question, is the volume correct? Because there's somebody here who has asked that question again. I can't quite see who is that? Me. Yeah, so saying the volume, the large volume, was not on the bar it's showing on the chart here. It should have appeared, yeah, on here, which is the Friday before. So Tom, of course, knows that. He's aware of that. We were talking about it before. Philip Friston, who's a VSA expert and a long-time trader, sent us an email, and the following was said by Philip. So this should explain what's going on, and Tom probably add to it. So Rita, can you read it out?
Yeah. Okay, it's from Philip to clarify all these questions about eSignal. There have been a number of questions recently about eSignal daily data, so here is a brief explanation as I currently understand it. eSignal intraday data should be fine. Their end-of-day data is, I believe, okay on stocks, although I have never tested it, although the last day can sometimes have massive volume, which is not correct. With indices, they do not provide volume anyway. As you know, the US futures exchanges do not release the actual volume until the next day. However, estimated volume is released and is generally a very good approximation. For end-of-day futures, eSignal, for reasons known only to themselves, release the volume on the wrong day, so it is useless as far as Trade Guide is concerned. He did attach a chart, but haven't brought it up.
Right, so what does Tom say about that?
So, sorry, hang on. So when looking at end-of-day futures, you're best to avoid eSignal completely. So we must always have the end-of-day program if we're talking about daily.
So let Tom
chart.
speak.
Okay.
Tom's got something to say about the whole subject. Sure.
Right. Okay, well, we know that volume or activity is so important to professional people. They know you can read it and get a lot of information out of that volume. So don't be surprised if they don't do their best to mislead you or hold it back or do something with it that's not correct. However, on saying that, remember, it's volume, spread, or range analysis. And that particular bar at the top, look, even without any volume here, which it looks like that volume was supposed to be on that bar, right? It's overbought. It looks weak. It's been marked up, obviously, deliberately. So, and remember, we use relative volume. So the volume figures has to be grossly altered to even mislead us in any way. But you'll soon get used to that. You'll be able to glance at the price spread and you can see clearly that we're overbought. It looks like the end of a rising market, even if there was no volume there. And of course, this upthrust here, which confirms the weakness. Once you see that, then you know definitely that this is all distribution here, without any question. Because if they wouldn't do that, if they were bullish, they certainly wouldn't do it, would it? Would you? If you were a professional there, you might shake out the market. You certainly wouldn't have an upthrust. So keep that in mind. Don't worry about it too much. It seems to all come out in the wash okay. We use relative volume, and it's a price spread is very important to us as well. So you can all see that that is weakness there. Look, even if the volume wasn't there at all, it looks weak, doesn't it? And that certainly it's a very, very clear upthrust here. And they'll only have an upthrust if all that previous action is weakness, and that's why it's fallen off, look. But we didn't use, I think we were talking about this last Friday, and we saw this upthrust here, and then we said, right, it's highly unlikely, very, very unlikely to go higher because of this resistance level here. Always keep in mind that resistance in the background. That's like a serious barrier to you, expecting higher prices. There's no way they'll go through that. Okay, so don't worry about it too much. The estimated volume seems to work, so don't worry about that too much. You'll learn to recognize the price spread, and the volume will automatically make sense to you. All right? No more questions about this, Daily?
No questions?
None?
Yes, yes.
From Edmund. Hello, Edmund. On this chart, Tom, with three tops at that 1460 level, Peter, could you do the... Is this a sufficient cause for the market to break the 1420 support?
I could only answer that question if I had a point figure chart. Now, point figure charts are very, very interesting and fascinating, and you can, in this case, you take account from this level here, right, over to where the first volume or the weakness appeared. And it's very accurate. It'll tell you roughly where it's going. But I haven't got a point figure, so I can't indicate how far down that's going. But that's definitely distribution, and then you just have to follow the bars, and there's a little bit of strength came in here because of this is the 50% retracement, I think, here, and it hit that middle retracement line, trend line there, and that's why it's gone up a bit. So I can't really answer that, but hopefully Gavin in his wisdom will be getting point figure charts into this software eventually.
Still on this chart, folks. Still on this chart from Alan, who asks, on the 14th of September, the upper bar indicates weakness. At the same time, you say the down bar on the 17th of September also is weakness. I thought that up bars are weakness. Could you explain why the down bar is weakness?
Well, I think we noticed it last week or the week before, that probably they held the volume back on that bar because it's unnatural to have that terrific high volume that we see there. There it is on that down bar. It's unnatural, but it would be natural, definitely, to have it on this up bar. And these professional people, they can hold back this data. We've seen it many, many times. And they hold it back, and they can release it on that. They come up with all sorts of excuses why they had to do that. But don't forget, we're looking at volume range analysis, right? So even that high volume, it's far, far too high. There may have been some buying on there, yes. But normally that would be buying. That would what we call stopping volume. But it's not stopping volume because stopping volume occurs after we've seen a down move. Like if you saw it here or even here. That's where stopping volume occurs, not these tops like this. That is a sign of weakness. The supply is present. And of course the upthrust confirms it. So you know definitely that that whole area was distribution without any question. Does that make sense?
Thanks. Yes, Alan says thank you. Peter says, in the new charting software from eSignal version 11.5, there are point and figure charts calculated in the Wyckoff way. Does everyone know that one? And Carrie says, whose volume should we use on TradeGuider end of day then?
Thomson Reuters.
And Gavin informs me Thomson Reuters. Sorry?
Thomson Reuters Metastock is who I'll use. I'll talk about it in the Detective Holmes event.
Okay, he said he uses Thomson Reuters Metastock, and he'll talk about it in the his webinar later on. Colin asks, would it be possible to post Philip's letter on volume into the VSA forum, please? Yes, we can, if it's not already. Philip's here, so if that's okay, Philip, we will do so. Yeah, okay. Tom, in your trading, did you ever use the Wyckoff wave, says Raphael?
To be quite honest, no, I didn't. I didn't use it for the simple reason is that you can read these charts, and pushing a Wyckoff wave in there as well, it's all very well, but to be quite honest, you don't need it, or I didn't need it. The syndicate never used it. But the Wyckoff wave apparently is very good. It shows momentum on these up moves, and all the information you get, I suppose, is good, but you can be overloaded with information. These top professionals, they see these things more in a few seconds, and bang, they're in trading. And if they happen to be wrong, they close it out straight away. So I must confess, I never used the Wyckoff wave, but I was fully aware of it, and it's still in use, I believe. Now, are there any more questions about this chart?
Any more questions on this chart?
What I can do now...
Tom, there is something I'd like to ask you. There was an end of a rising market signal on gold 6 days ago that I drew people's attention to. Today gold's collapsed.
Right.
It's fallen dramatically. I'm short gold at the moment, okay, so I'm making money on it. Could you address that to the group? What is the end of a rising market? And they can go and view the YouTube video from yesterday where I actually showed the short, and it's gone short today.
Right. I don't know if you heard all that, but Gavin's sitting a few feet away from me, and he said that a week ago there was no demand.
No, end of a rising market.
Oh, sorry, end of a rising market.
Yeah.
Oh, that's your favourite signal, isn't it?
I'm short gold.
So Gavin shorted, and apparently he's in the money. at the moment, which is good news. End of a rising market. It's really a form of climax. That's why I would suggest it's a good idea to specialize in a vehicle, because you get to see its characteristics, you get to understand it, and of course gold, remember that there's a lot of non-professionals in there, a lot of the public, they like to have a go at gold, and therefore it can behave differently to some of the other professionally driven markets, like some of the commodities. So of course the end of a rising market is what it says it is. It's you see the bull move, you see an up move, a potentially powerful up move, right? Then one day it's marked up, usually gapped up, right? The news is good, everything is rosy, everything is wonderful, right? Prices are going higher, right? But it's gapped up, and you notice the spread is very narrow, and you notice the volume is ultra high. That's selling, because the professional money or those behind the gold have enticed you to imagine or think with the gap up that's going to go higher, and a lot of people will fall for that, and that's why it's there in the first place. That's why we call it end of a rising market. And if you ever see that, especially if it's in fresh high ground, especially if it's overbought, that's way above the trend line, you can bet your bottom dollar that's serious sign of weakness. But we'll have a look at gold in a minute. But Gavin's short it seems to be working okay.
Okay, Philip is okay with us putting his letter on the forum, so we'll do that. I've made a note to do that. And Peter says, when you put time interval of 1440 minutes, the position and values of the volume bars seem to function a bit, and I work in this way. Peter's just trying that now. Are you doing it?
I typed in 1440 and it just automatically reverted to days, so it didn't make any difference for
Well,
us.
here you are then. Can you mention that?
Yeah, so I've just tried that 1440 as the time frame for the future, but the software then reverted to daily. So of course 1440 is the same as 24 hours, and hasn't made a difference to us. So I'm not sure whether I did that correctly or whatever. So what was the next question, Rita? Or was it gold we're looking at?
No, let's look at the hour chart.
Okay, so going to the hour chart for the S&P 500 E-mini.
There it is. Looks a bit dramatic.
It doesn't it? Yeah. Tom's saying it looks dramatic. I'll hand you the mic, Tom.
This is an hour.
Yeah.
This is the hourly chart of the S&P. That's just the hour chart of that index we're just looking at. Right. There'd be no demand up here, look. There's a signal there.
Supply coming in.
Supply coming in, right. And then that blue bar is supply present, look. It's plummeted down, and there's some sort of stopping volume has appeared.
So shakeout.
Shakeout, same thing. Well, when I say it's the same thing, they plummet the market down deliberately, right? The volume is very, very high. It closes just off the low there, right? Now, that doesn't mean to say you go in. It just means it's potential stopping volume. In other words, potentially professional money have stepped in. Now, we've got to let the market prove this to us before we do anything about it. And what normally happens is, if it's bullish, well, if it tends to go up, right, you'll see 1, 2 up bars here, and then further along here, it'll come back down into this level. So we draw a line across here, look. There it is, look. If the market goes up a little bit. Here, up, goes up, and then comes back down to that level. And the volume is clearly low. Preferably the computer's colored it pink. That means that market's going to go up. And it'll keep going up until the sign of weakness comes in. Okay. Now this is our chart, look. So it's picked the top here, look.
Potential buying climax.
Right, but now, okay, potential buying climax. That means it's a similar principle as we just said, the end of a rising market, right? First of all, you've got to have an up move behind you. Once you see these up moves like this, right, then what you're seeing is the market has become vulnerable. Imagine if you were in a long position and you see, or you're making nice profits, right? That makes the market vulnerable for you to suddenly say, right, I think I better start distributing, get holdings out of here. Okay? And that's exactly what's happened there. And so because it hasn't gapped up, and because the spread is reasonably wide, we call that climactic action, not end of rising market. They know it's weak, so they pump it up, look, to make it, what's that?
Supply coming in.
Supply coming in. Down it goes. And so...
No, I'm actually short gold and somewhere else. I'm short here on the euro.
Now Gavin's here talking about gold.
Following on from Peter's comment about putting in 1440 minutes in there, he tells us that eSignal charting software with an add-on does not do that, so that you can see nearly the daily charts. Thank you, Peter. Okay. Maurice, given what Tom said about the gains with volume, if we see high volume at the top of a move and the market is moving sideways, does it really matter if, after an up move, the high volume is seen on a down bar or an up bar? So no, sorry, no one's listening to me. Well, you might all be listening to me, but no one in this room. Tom, did you hear that? No. Given what Tom said about the gains with volume, if we see high volume at the top of a move and the market is moving sideways, does it really matter if, after an up move, the high volume is seen on a down bar or an up bar?
Well, generally speaking, markets do not like very high volume and up bars. It's more acceptable on a down bar, and very often you do see the market fall on very high volume, and it will hold for some time. You have to follow the bars very carefully then. I mean, it looks really as if something like that happened along here, perhaps. There's some increase in volume, look. There must have been some buying there, and on that buying, it supported the market, or they supported it, look. But you know it's basically weak, because most of these up bars, look, blue up bars, are on no demand. Right, so you've got to be aware of that. But keep an eye on the price spread as well. And if you do see high volume on down bars, if it's bullish, it's going to test of some sort. But this is different here. This is more like a stopping volume here, because we've seen a substantial down move, and then the high volumes come in on this down bar. Now that could easily be stopping volume, but at this stage we're not sure. If it's genuine stopping volume, we'll see a test of some sort along here. Now it's Friday, So you've got to be very aware Fridays is often distorted deliberately by professional money to mislead the TV people, the newspapers, magazines, and the pundits all over the weekend from newspapers and things that you will be reading. And you can't help it, but on all that information you're absorbing, right, if you do read it, it will probably form a gut feeling. And that gut, you can bet your bottom dollar that gut feeling will be wrong. If you're convinced that market's going to go up, right, and it's based on a gut feeling, it's probably most likely to fall. And that's how the market seems to work, because you have to have more losers than winners for these markets to work like this. If everybody's a winner, be untradeable. Of course, everybody was a loser, it would just plummet down to zero, I suppose.
You were talking about gold, and Lance says, I trade spot gold, but how does this ETF have an effect on spot? Am I missing something by not having the GLD chart?
I can answer that.
Gavin's going to answer you.
Yeah, hello, Lance. It's a good question. No, both, but remember, the futures contracts and the ETFs, they're all arbitrage. They're all going to move the same direction. Go and look for yourself. But you will see some small nuances. But choose which market you trade. I trade the futures market, so I trade the GC contract. But for those of you that trade the GLD contract, that is a contract that you can use to hedge. I hedge using options, because you can trade options on the GLD, and of course you can't on the GC contract. Now, if you are not familiar with what I'm talking about, I'll talk a lot more about this in the seminar I'm doing at 1 o'clock Chicago time with Infinity. I'm back for the Detective Holmes event, so I'll talk a little bit about the differences between the contracts. But in simple terms, when we do the closing bell tonight, and I'm going to be contributing to that, we'll look at why the two contracts have to run in alignment. So the GLD will not move out of alignment with the GC contract. So don't worry, Lance, if you're trading one contract. Just trade what you see. Don't start getting too flustered with all the different contracts. Otherwise, what tends to happen is you tend to confuse yourself. Just keep it very simple, and you'll be absolutely fine. I'm just watching now at the moment a trade here that I'm looking at the moment, which is on the euro and the pound as well, where I'm looking quite intently at what the market's trying to do here. And again, it's running pretty much in alignment. It's spiked up, which is what I'd expect. It's been in a downtrend. It's now at a resistance level at 6071 on the pound, and we're looking now for a push down through 6063, which is a target for me. And so I'll talk more about that in about 45 minutes in the Detective Holmes event that I'm doing with Infinity Futures. So yeah, so Lance, I just say to you, trade what you see. If you're trading the GC contract, look at the principles in that contract and trade them. If you look, and we will later on look at the two contracts together, the GLD and the GC contract and gold, you'll see their signals are very, very similar. We have seen the end of a rising market in gold a few days ago, and sure enough, just as I predicted last night, gold has had a very nice downward move today, and it's very tradable. In fact, I'm not logged into this webinar, but it's a beautiful chart. It's got signals all the way down from 1774, which was the area I discussed last night. We're now down at 1761, and it's still going. So good opportunity. Anyway, back over to Tom.
Yeah, thanks for that, Gavin. Yeah, so if you're really seriously interested in gold, I would suggest you log into Gavin's
Detective Holmes.
Detective Holmes.
Former policeman. Makes good tea.
That makes very good cup of tea, does. Definitely.
Please char.
Yeah, please char. Guarantee that. So, but he seems to know what he's talking about with all this gold, and he's making money from trading it. So that's the proof of the pudding, as they say. Okay, so what have we got now? We've still got the S&P 500 chart up. right? What time frame is this, Pete?
10 minutes.
10 minutes, sorry. Yeah, now this is a 10-minute chart, look. So all these different time frames do work, and that's why you can flick around and you'll find information on most of these charts. Now, there's some strength came in here, right? And here, that's what's brought that signal up.
Test after shakeout.
Test after a shakeout. So please read the dialog boxes. Right, very important. Okay. Now, that's fine. So we know that there's some form of stopping volume appeared. We've got a down move, which we know we need, makes the market vulnerable to one or more professional groups thinking they might make some money by going into the market when they have to go in on a down bar because of the size of their orders. These are traders, Gavin calls them smart money, that can throw 4,000 or 5,000 contracts into the arena. This coupled with other professionals who see them perhaps doing that and may follow suit. And so we know that there was some form of stopping volume here. Now on that volume, look, it's just drifted up slightly, which we expect. Look, there's not a lot of no demand there. But what we would like to see is somewhere along here, the market falling down. I'll draw a line there. Right, there's that line there, look, going right through that bar where the volume is. If this market falls down and hits that trend line, or that horizontal line, and the volume is low, especially if the computer colors it pink, then that market's going to go up. Right, it'll keep going up until you see a principle of weakness coming in. Doesn't mean to say it's going to go up to heaven, this. It just means that it will move up until you see a principle of weakness appearing. Now this does work, look. The up thrust up here, look.
Up thrust after weakness.
Up thrust after weakness, look. Right, once these markets trend down, you'll see all these red bars. It's exact opposite to the market trending up. All the time the market's falling, the close of the bar is lower than the close of the previous bar. You ignore level bars, which are colored in black, look. That means it's a level bar. And that's done all deliberately because all those traders that were up here, right, if they hadn't closed their position, they would be locked in, and they are potentially weak holders. That means that if they sold right now, they show a loss. Traders don't like that, so they hang in there hoping and praying for an up move. But the market makes sure there is no up move until the principle appears, and that's why it's so important that you close your trade out if it's a losing trade fast as possible. And there you are, stopping volume has come in here, look, right there, look, and that's why it's drifting sideways. If it falls back down to that level and the volume is then low, pink, right, then that market's going to respond upwards until a sign of weakness appears. Now, is there any questions about that chart?
No questions on that chart, Tom, but there is a question from Rafael who says, was there a difference for you when you were trading in the syndicate or after that as a retail trader? Because in the past you knew where the price will go, but as a retail trader, not. Does that make sense?
I didn't understand. Read that again.
Right. Did you feel a difference when you were trading in a syndicate or after that as a retail trader? Because in the past you knew where the price would go, but now not.
What he's asking is, when you were inside or on the syndicate, you had a slightly better advantage.
Oh, you did, definitely.
Yeah. So did you feel a bit of a difference coming out of a syndicate, being on your own? You could read the charts, but you didn't have all the knowledge that they had, or was the inside information?
Well, that's true.
You couldn't manipulate the market on your own, is what
No.
I'm saying.
No, that's true. Obviously, when you work with a syndicate, don't forget what they're doing, they're targeting individual companies, individual stock, and they're absorbing what they call the floating supply. And once they've removed the floating supply, which can take weeks or even months or even years, right, you've cornered that market, and therefore you're not least bit concerned because you control that stock, you control that price, and it obviously makes it much, much easier to trade. You can do a shakeout and you're not particularly concerned because you're the one doing the shakeout. And you still have to trade in harmony with the general index because you need a general flow of orders to assist you in your move of an individual stock. But when I left, right, I came back to England. It's not an easy place to live, Los Angeles, I'll tell you, all that smoke and everything. But anyway, it's far more difficult when you're isolated on your own. Then you have to knuckle down and really understand and read the charts. Of course, what helped me then was that to program it, I had to study it very carefully and instruct a programmer, you know, how to get these rules up. And you need ultimate concentration for that to work, because computers, as I say many, many times, computers just don't understand flaws in your thinking or your logic or your activities. It just doesn't understand it. You either got it right or you haven't. And to get it right, initially, I mean, I wasn't a programmer. I didn't know much about computers, but I knew how the market worked. And that's the thing. So that helped me a lot. You know, I even said to Rita and Peter here, I said, look, you could write your own newsletter and you don't have to publish it, but you could write it. And the fact is, you're writing a newsletter makes you concentrate because you want to get it right. And if you publish it, you certainly want to get it fairly right. And therefore, it requires concentration. Sometimes it's not quite right, but usually it is if you get it right. So it is far more difficult. When you're with a syndicate, of course, you get swept along. And, of course, life is very easy and rosy. And everybody's having a good time.
There is now a question on this chart, Tom, from Grigory. There is a test after shakeout on this chart. We've got the cursor on it. But there is no signal of a shakeout before. So why is it called a test after a shakeout then?
What, that one?
Yeah, that's it.
What's it called? A test?
Test after shakeout.
Oh, it says test after shakeout.
Yeah, so he's saying there's no...
It's because there's no signal on the previous bar, but it's measured the high volume, is what I think. That's what it does.
Yeah, well, what happens is the computer has noted of this terrific high volume here and that market plummeting down like that here on that bar there. And then after that event, then this definitely looks like a test, doesn't it? Narrow spread, down, close near the high, and the volume is a lot lower than this area here previously. And that's why it's called a test. It may be a bit sort of, but there's a signal there.
Oh, a yellow box, yeah.
A yellow box. Can you put the yellow box up, Pete?
It didn't get confirmed.
Potential stopping volume.
Like a shakeout anyway.
Yeah, so there it says on there potential stopping volume, which we know about. And then this is definitely a test look, because you can see it's a narrow spread, right? It's a red bar showing it must be down. It's closed near that, well up, look, and the volume is considerably less than this. And don't forget, we're looking at relative volume. Okay, and that's why it's called a test. And that's why it's named like that. Maybe some way of making it easier, I don't know.
Great. So, thank you, Tom. You've explained that well, says Gregory. Me would like you to comment about on this chart. This is the NASDAQ 1 hour chart.
Keeps catching up, yeah. Now the NASDAQ, first time I've looked at this for several days, but I know the NASDAQ, don't forget. The arbitrage traders make sure it runs up and down with the S&P 500 main contract. So there's your weakness at the top, look. Right. This is really, as Gavin says, a gotcha bar. These wide spreads down like that on this increase in volume is done deliberately to lock as many people in the market higher levels as possible. Now it does look here, we've got some stopping volume of some sort here, look.
That one there, shakeout.
Shakeout, yeah. And on that there must have been some support there, look. It's drifted sideways with the rest of the market, and then we suddenly, markets don't like this high volume business. And that high volume look is on up bar. Sudden high volume look. Markets do not like that. And that's why it's come off like this. However, there's not a lot of selling pressure here at the moment. What's that box say, Peter?
Well, it's not finished yet, but what it may say is there's no supply. But it's nowhere near finished.
Oh, it's nowhere near finished. Oh, it's an hour, is it?
Yeah, not even close.
No.
It'll
Okay.
be finished with Detective Holmes starts.
Oh, will it? Now, does that make any sense?
Okay, talking about Detective Holmes, Carrie's asking, how can we log in to Detective Holmes today? Was there a problem?
There is an email that's just gone out to everybody. Now, can you ask everyone in the group, did they all receive an email from TradeGuider in the last half an hour or hour?
Question from Gavin, did you receive an email from TradeGuider within the last half hour or hour? To everyone?
Could you link for that? Yeah.
With a link for it? Yes, says Park. Yes, says Thomas. Oh, Carrie's going to check. Yes, Edmund didn't. Few people didn't, but not everyone's typed in. But oh, go. Yeah. Yes. No, few no's and mainly yeses.
Okay, so you can let everyone know I'm logging in now to this webinar, but I'll post it in the room.
He's logging into it now. He'll post it into the room for you all.
And actually, I can show you the gold chart now. That would help.
Okay.
Oh, I can use this one. Oh, actually, I will do. Let's see. Okay, hi everyone. Let's just do a quick sound check as I swap over mics. Can you all hear me okay? I'm just logging in on the second computer here. I'll show you the trade. Okay, let's turn that off. Okay, let me put the link up for you. I don't know why this is not muted. That's better. For some reason, there's a microphone on the laptop and let's try that. Let me switch this one off. Okay, that should do it.
Have you put the link up?
Yeah, just putting it in now. Can everyone hear me okay? There's no echo? That should be better. Testing 1, 2, 3.
Yes.
Okay, I want to make sure there's no... here's the link now. Can everyone see that, please?
Yes.
Yep, can everyone see that?
Yeah.
Just to be clear. Great. And then the closing bell is at 9:30 UK time. So that's going to be about 3:30 in the United States. Okay, let's just show you this. Yeah. Peter just made a point. Please copy that link now because when we close this session in the next 10, 15 minutes, you will lose that. So make a copy right now. And let me just put my chart up here. Can you all tell me when you can see a chart of gold? And by the way, it's very important for this, what I'm about to show you, to look at the webinar that we did last night, which I've posted on YouTube. It won't make any sense to you unless you look at the YouTube video that I did last night. Okay, can everyone see gold here? GC contract, 3-minute chart. Okay, that's where I went short. Can everyone see this?
Yes, they can.
Okay, good. All right, perfect. Okay, now I'm going to talk a lot more about this in Detective. I don't want to take over Tom's seminar. It's not my intention at all, but as we've talked about it, what we'll look at is a number of things. We had a signal in the end-of-day software called the end of a rising market just over a week ago. Now, I've always, of course, as you know, I've always looked at gold as a great place to trade because it's heavily manipulated by the large institutional banks and the governments. I mean, they move this market. Now, does anyone spot Yao Ming on this chart on an up bar? I mean, I'm sure you all see it. It must be jumping out at you. You've got two signals here, as you can see, supply entering the market, and right here, you're up thrust. Okay, so, and that came in about 4 or 5 hours ago now. It was a really clear indication that they're trying to get traders to go long. And the news has come out. There've been some bullish news on gold. But we know we're better than that because we understand volume, and Tom's taught us volume spread analysis. And we see here a clear up thrust, don't we? Everything lines up. You've got weakness in the background. Okay, that's the first and most important part of the chart. Right there, look. Okay, weakness. Let's just say why is that a weak bar? Okay, I'm going to explain why. Look at the volume on it. Okay, absolutely massive. Okay, massive. And let me just for a minute switch off the crosshairs here and close that down and just talk about these bars. And look at what's going on. There's the high volume. The market's marked up through a resistance level. And what happens is traders think all their technical analysis is telling them go long, go long. The stochastic says go long. The MACD says go long. The moving average says go long. But TradeGuider says supply's coming in. Now think about that. The next bar, look at the spread of it, very narrow. And the volume on the next bar is still higher than the average, but the spread is narrow. So something's capping the market here. But I'd never, ever go short there. Can anyone tell me why? Why wouldn't we go short right there? Anyone tell me why? Why wouldn't we short on this bar? Even though it's a good bar, in hindsight, why wouldn't you short it? Rita, what are they saying? No confirmation. No change in behaviour. Well done. Absolutely. The market has not changed behaviour. It's still going up. I don't know that's a market top yet, but I have a sneaky suspicion why I was going to look for shorts, because I have in the background on the daily chart the end of a rising market. So I've got weakness on the daily chart. So this is an artificial markup. Now what do we have? Look at the volume on this bar. Beautiful up thrust. Look at that. Doesn't get any better, does it? Weakness in the background, up thrust. Now here, I get suspicious. There's two tests. They're testing. Is there sellers in here? Oh, yeah. There's your gotcha bar. Now, interestingly enough, these two bars produce green signals
on a 3-minute time frame. And people look at that and go, oh, well, are they buying here? No, we've got a change in behavior. So I wait. I don't even look at this. I wait. Market trends, the diamonds stay red, the bars stay red, and then we get the real clue as to what's going on. Ladies and gentlemen, the market goes up. What happens to the volume? Can you all type it in? The market goes and rallies here, produces a signal right in here. What happens to the volume? What? It's not going. It's disintegrating. It's gone. The professionals have sold. The smart money have sold. As they've tried to put the market maker on the exchange is trying to keep this market high. He's trying to keep traders locked in. Bang. Goodbye. Night, night. See you later. Everyone should be short, but they're not. They're probably long from up here, and now they're locked in. But as I'm going to show you at 1 o'clock, the end of a rising market is why gold has gone from here, very nice setup. It's gone down, what, 59 from nearly 70s. I mean, it's a massive move. And, you know, we see this all the time in gold. It goes up and down each day because it's being manipulated. And, you know, we know this. It's in the media. We know now why this market moves the way it does. Here we have weakness, potential weakness in the British pound. Here, potential weakness on the euro. We're in a downtrend, but look at the background. What have we got? What have we got? Potentially a great trade. And I'm short, you know, I'm short both these contracts on this account, okay? Yes, it's put me under a bit of pressure, but it's a small, you know, I know exactly where I think I want to be with this. And if it goes up and spikes up and takes me out, there's where my stop is, just up here, then that's the way trading is. But we know a couple of things. If it's going to push through down to here and hold its line and come back down, then we're going to have a decent move down. If it spikes up, you get stopped out the trade. That is the business of trading. Please remember that. There are no guarantees in the market. You will be put under pressure the minute you put your order in, I promise you. They are not going to allow you to make money quickly. It's going to take time and patience. In fact, Gary Dayton did a trade in Australia. He was in it for 4 days nearly. He was under pressure at one point. He was $1,400 down. He made $6,000. Most of you saw that. So remember, you've got to be a good trader, which means being a good risk manager and understanding what risk is. And remember this, when you take a trade, know what your limitations are. I know exactly where my stop is. I know why I've got my stop there. I know I will never let it run through that. If it gets stopped out, I thank the market for stopping me out at that point. I'm not angry with it because there are many other opportunities coming. And the gold chart, as we'll see, will be an absolutely super trade if it does what I suspect, and we're going to look at that very shortly. Now, interestingly enough, there's Jeffrey Gibby texting me. He's the one of the guys at Metastock, and I'm working closely with them at the moment on a release of a scanner in Metastock that's scanning for some of these setups, and we're working on that right now. So anyway, let me hand you back to Tom. 3 minutes to go, but suffice to say, you can see these charts setting up. You can see why they're setting up. Most importantly, though, I think this gold chart today, please go and look at the video I did yesterday. Several of you have emailed me. You took the short. It was the end of a rising market, and I'm very pleased that you did. And where do I think it's going? 1,700. I think it'll get down there, definitely. Okay, back over to Tom. Can we get my chart back? Yeah. Right, thank you, Gavin. That's very good. It's always interesting to listen to you talk. Always. And Peter's just getting my chart up.
Yeah. Okay, Tom.
So what chart's that?
Well, this looks like a 4 hour of...
no, we want the S&P 500.
Yeah,
it's a pound, sorry, no.
yeah. S&P, what time frame?
Well, an hour is good. Oh, that's better. That looks more like it. So we're back here. We are back here to the S&P 500 futures. It's an hour, right? We've seen what looks like, well, it is, stopping volume.
Hang on, Tom. I don't think the screen is showing. Take it.
Yeah, it did.
Yeah, it did, but it's gone back. Look.
Can you all see the screen?
Oh, actually, you give it to me there. Hold on. Let me give it back to you and see
Okay.
if that works.
Yeah.
There you go.
Oh, that's
That's all right.
better.
Yeah, got it.
Sorry about that.
Okay. So they can all see the screen now.
Yeah.
Right. Okay. So we are here looking at an hour of the S&P 500 futures, and we can clearly see that we've got stopping volume down here, and we're now expecting, or if the market trundles sideways, goes up a few bars, and then dips back down to that level sometime later on today, and if the volume is clearly low, then we're going to see some sort of rally. Not a bull move by any means, but it will show some up move. And you can trade that until you see a sign of weakness appear. So that's very interesting. Okay, well, thank you, Gavin, for that little talk. It's very interesting, as always. Gavin's always very well worth listening to, I can assure you that. And are there any questions about this chart before we go?
No.
Okay. Okay,
Are
well,
we doing a newsletter, Tom?
yeah. When are we doing the newsletter?
Well,
Saturday or Sunday?
I'm happy to come tomorrow at midday as usual, unless you've got something going on.
No.
Yeah, so at the weekend we'll have the newsletter anyway.
Yes.
Well, we'll have a newsletter over the weekend, and I'm sure Peter will get it up on time, and Rita will type it all out. And it's always worth studying that newsletter. Rita just types really what I'm thinking. So there's no real clever technical stuff, no formulas of any sort. It's just the flow of thoughts in my mind as I look at these markets. And I'm sure it must be a good help to you to follow the way of thinking, really. And they're usually fairly accurate. And we'll see what happens. But I'll hand you over now to Peter and say goodbye.
Okay, folks, that's it for this week. Have a good weekend. Don't forget, Gavin will be on, in half an hour, roughly?
And then again at 9:30.
And then again at 9:30 with Ken.
Philip will join us as well with a bit of luck.
And hopefully Philip will join us with a bit of luck. So, we'll say goodbye and see you soon.